Good evening. First of all, I hope you all are staying safe and healthy. Please take good care of yourself. While this health crisis came unexpected, it has also given everyone an opportunity to reimagine their way of doing things. And same with our CFA Society in India. We started a webinar series from 30th of March, and with efforts of our volunteers and staff of CFA Society and the Institute, we have already conducted 25 webinars. I thank you for your active participation. We are encouraged by the live attendance as well as your response on the social media. I've been part of this series, and we had the privilege of hosting Dr. Subbarao, Ashish Gupta of Credit Suisse, Punita Kumar Sinha, and many other speakers, both from India and outside. We have lined up many more interesting sessions and workshops in weeks ahead. We are working with our global colleagues to get a number of marquee speakers like Professor Ashwat Damodaran. Now, talking about today's topic, it deals with the mind, a place that generates the real alpha, not just in markets, but in life too. The mind, however, also can drain energy. The brain is among the biggest sources of personal energy consumption. The times we are living in are uncertain, they are unusual, and they are unprecedented. How does an investment practitioner think and act in these times? From investment ideas to thinking through the mosaic of options, our minds need to be in the top, our mind really needs to be in the top form. We have a unique session today to focus on the toolkit professionals need, and my friend Jason Voss, and I'm very happy to have him today, is the right person to guide our members. Jason will be talking about how to enhance creativity, as well as how to use a kind of toolbox which can help us in generating new investment ideas. He will share his secrets of how to interact with and interview the management, which is very relevant for all of us who are in the investing profession. He will talk about behavioral biases and mistakes, and also the techniques for controlling those emotions, as well as overcoming these behavioral biases. With that context, Jason will talk about the importance of meditation for investment professionals. As a very famous investor, Ray Dalio, said something like this, that more than anything in my life, meditation was the biggest ingredient of whatever success I have had. And I fully echo what Ray Dalio said. I'm very glad that Jason will touch upon the role of meditation, what it can do in making us not only a better investment professional, but in making our lives happier and more purposeful. Just a few housekeeping announcements. It is a 1-hour session, starting with a presentation by Jason for around 30-35 minutes, followed by Q&A. All participants must use the Q&A box to ask relevant questions. Presentation will be shared with you in the chat, and also will send you on the email. I will also urge you to take the survey and give your feedback. That's very relevant for us. That's very critical for us. The link which is shared in the chat at the end of the session, and this will also be shared in the thank you email. Recording of this session will be available on CFA Society India YouTube page in a few weeks from now. Before I hand over to Jason, a few words about him. Jason Voss, CFA, is a senior consultant at Focus Consulting Group, a firm advising active investment managers on how to improve their cultures and processes. Before this, he was a global content director at CFA Institute. As a practitioner, he has ran the Davis Appreciation Income Fund, which had a Lippo 1 ranking, got the Morningstar's first 10 funds, which got awarded Stewardship Grade 1, if I remember correctly. He's a frequent writer, has published research in multiple journals. He's a frequent speaker, particularly on how active investment managers may improve their performance. He's author of many publications, and I'm just listing a few. I think Meditation Guide for Investment Professionals, Return of the Active Manager, The Intuitive Investor, and many more. With these words, I'm happy to invite my friend Jason Voss for his presentation.
Such a kind introduction. Thank you so much, Navneet. I really appreciate that. My housekeeping bit will let me share my screen so you can begin to see my slides. Just a moment here. All right, there they all are. Navneet, you described everything perfectly. Today's focus is on the mind, and in particular, the behavioral aspects that tend to repeat themselves in the markets, both those of other market participants, those of the investment management teams that run businesses, as well as your own mind. And having an appreciation for those aspects of investment management, I believe, was the biggest differentiator in my career as an investment manager. And now in my life as a consultant, I can say that when I engage with firms to help them try and improve their alpha and also improve their returns, investment process as well, usually the errors are errors of judgment, and the mind is, of course, central to our human judgment and perception. So today we have a lightning round. I mean, it's going to be a very fast plow through 4 very important subjects, and I've tried to make it practitioner friendly, meaning I'll share insights that hopefully you can take into your practice directly. All right, let's see. All right, next slide. Okay. All right. So the first thing that we're going to discuss is using creativity for generating investment ideas. To me, this is an underappreciated subject within investment management. We tend not to think that creativity is important. We tend to overemphasize the left brain analysis. In fact, the job titles that we carry around if we're practitioners tend to be research analysts. They're not research creativists, if I can invent such a term. Yet, if you look at the definition of creativity that I have here on the screen, it matches and jibes very closely with alpha. So we have creativity defined, the ability to produce work that is novel, that is original, unexpected, high quality, and appropriate, and meets task constraints. That definition actually comes from a number of creativity researchers who for over 100 years have actually researched creativity. But we don't really research creativity in the business realm. In fact, most of the research that's been done is in the academic education realm in terms of how to better educate students so that they can begin to tap their creative faculties. And that definition that I provided here is a synthesis of many of the definitions, and that's sort of the center of gravity. And if you think about alpha, it tends to be the ability to produce work that is novel, that is, it returns in excess of what can be explained by beta. It's appropriate as well. It meets task constraints. In this case, your investment charter, or it could be, the consultants have various measures by which they measure yourself. And of course, creativity is the source of any new ideas that you have. And very simply, my own personal definition of creativity is doing what nobody else is doing. And by definition, the job of the investment manager, if they are in pursuit of alpha rather than index-like returns, is to do what nobody else is doing. And here I'm sharing with you a very practical framework. We use this at Focus Consulting Group when we advise investment teams on how to improve their creativity. We call it the Big 5 Necessary Creativity Conditions. This material actually comes, again, from those creativity researchers who've identified, very mercifully for those of us who maybe are not so strong with our creative abilities, they have identified necessary conditions, which if you put those necessary conditions in place, their research shows you will in fact have more creative results. And there are lots of ways to measure that. And if you're interested in the Q&A, I'm happy to talk about some of the ways in which they measure creativity. The first here, and notice, by the way, the acronym is IDEAS, I-D-E-A-S, and I'll take each of these in turn. The first thing that you need in place is IQ, or expertise. And many people think that this is exclusively the only condition. In fact, I've seen multiple people over the years in the investment business, I think, commit an error in judgment, and they say that you have to be an expert in order to have insight. I don't think that's true. I think the value of IQ and expertise is if you have familiarity with a body of knowledge, you're better able to identify what's original because you know and are familiar with a lot of what is already available. But in addition, you already have a language with which to describe your insight. And we have all had the experience of having an insight that eludes our ability to describe it. And they tend to be very wild ideas. And there's a saying, at least in the United States, the idea was on the tip of my tongue, meaning I can't quite express it. So IQ is a necessary condition, but not sufficient. Not only that, and this is something that, again, I see many people don't understand, IQ is also the source of our bias, because we tend to invoke mental models which are very common to us, and we exercise them over and over again without awareness or consciousness. And in so doing, we commit many of our behavioral errors in judgment. And I neglected to mention when introducing this, these 5 interrelate, and you'll see that in just a moment. So the next of the big 5 necessary conditions is a spirit of discovery and curiosity. And discovery and curiosity, we tend to coach at Focus Consulting, is an internal process. You need to have familiarity with yourself and your capabilities, as well as an acknowledgement of what your personal limitations are. And curiosity, or that sense of discovery, is really a willingness to explore and stretch yourself on an ongoing basis. And of course, that then brings us to the E, EQ, emotional safety, which I think of as the wisdom aspect of creativity. That is seeing the world or accepting the world for what it is, not what we would prefer it to be. And that's helpful when we're evaluating ourselves. And going back to the discovery bit, if I acknowledge I have anxieties or fears about something or ignorance about something, if I'm a curious person, I don't let that stand in my way. I instead see it as a practice of constantly stretching myself and learning new things. And that is how the I, the D, and the E interrelate with one another pretty well. I have to have the wisdom enough to know my own limitations. I have to also have a willingness to explore, and I have to have the ability to tamp down any anxieties or fears of ignorance that I may have. The next one, and probably the most important thing I will share with you today, is attention. Most of us tend to think that we're very good multitaskers. There's lots of research that shows in negative correlation with those who report, self-report, having high levels of ability to multitask and their actual ability to do that. Don't let that be you. And I have a little bit of data. Forgive me, I'm going to look down at a sheet here that shares some of the data around attention. And the data is in fact dated, in that some of it comes from as early as 2012, and the world has changed, and it has to do with attention. So in 2012, adults they check in with their smart devices every 6 minutes, or approximately 150 times a day, which is obviously not attention, right? Because usually we're looking at multiple different things on our smartphones. Adults also represent to researchers that they are task switching up to 17 times per hour. At work, and now it's different in the COVID era because we're on Zoom or WebEx or whatever the technology, but it used to be the case in the office. We are interrupted on average 4.3 times by email, and we are interrupted by smart devices and other notifications 3.2 times an hour. And in the case of emails, almost half of us report immediately dealing with an email when it comes into our email inbox. And if it's something on our smart devices, 70+% report immediately dealing with it. Now, here's the sad thing for attention. It takes on average 10 minutes to deal with these interruptions. And if you think about the math I just shared with you, it's about 6 interruptions per hour. So basically in an hour, we're not in control of our minds and our creativity. Instead, our email and our smart devices are controlling us. Not only that, but it takes, if we were in a flow state, which is a creative state, it takes 10 to 15 minutes to re-engage and get our minds reoriented the same depth and flow state as we had before the interruption. So attention is wonderfully important if you want to be more creative. Businesses can help, which brings me to S, support. This is emotional support. Many firms don't do a very good job of supporting failure within their organizations or encouraging experimentation. This also, though, could be a personal level of support. That is, turning off your email or only responding to emails during certain hours of the day so I can have uninterrupted time in order to be more creative. I'm going to pause there. Navneet, do you have any questions or comments before I proceed to the next section?
No, I guess maybe you can complete your presentation. I mean, I really like the acronym ideas, and maybe I want to take a couple of more minutes, particularly on the attention aspect. I think you've mentioned quite a bit, but in this era of excessive information, and when everybody is looking at social media and this world of Twitter, too much of information and far lesser amount of thinking or observation? I mean, how do investment professionals balance these two things? Because information is not knowledge, knowledge is not thoughtfulness, thoughtfulness is not wisdom. So how do you move from information to build that wisdom which makes you a good investment professional?
It's such a great question. In our consulting work at Focus, when we've advised on creativity, these are exactly the questions that arise. How do we restore attention? The first is, and it's a global point, and I know, Navneet, you agree with me, I will take 1 ounce or 1 gram of understanding over 15 ounces or a pound of data. Right? It's the insight that's important, and the creative insight is especially important. And so the idea that we need to assess more and more information in order to compete, I think, is a misnomer. I think it's much more important that we have understanding with the amount that we do, and equal parts of analysis as well as creativity are crucial. So that's the first thing. If you agree with that, then the question becomes, how can I, as an investment leader, put that in place at my firm? One example is, I know of firms that have creative Fridays. So on Fridays, that whole day, they're not meetings scheduled, they're not conference calls scheduled, and the analysts are allowed just to work on big projects. If they have an insight or an idea, they want to refine their valuation model, explore new directions of data relationships, whatever it happens to be, it doesn't matter. That is what they do on Fridays. And Fridays are uninterrupted time to be able to focus on that. Alternatively, I am aware of a firm that we've advised that for 2 hours each day, they set aside for creativity time, and it's built into the schedule. They have shared schedules via Microsoft's Outlook, and for 2 hours, they have time that is blocked out, and it's understood you cannot interrupt the colleague during that time, and that's what that time is for. Of course, that works out to about 10 hours per week in a 5-day week. Other things that can be done are how you structure meetings. Oftentimes meetings are very poorly structured and not done well, and you don't get creative insights. Meetings where brainstorming is on the agenda tend to be disasters, and research has shown that they tend to be an arena for dominant personalities to further express their dominance, or for conventional ideas, guess what, to bubble up to the top. So the proper way to put in place good meetings where there's lots of attention is you must send out an agenda with a request up to 5 business days before the actual meeting, and you ask people to spend time thinking about solutions, because as we all know, sometimes creativity happens when we least expect it. We're on our morning commute into the office, not so much in the COVID era. In the COVID era, it may look like we're taking a shower or a bath, and that's when we have our creative insight. And so by allowing the lead up to that moment of the meeting allows for more of these ideas to percolate to the top. And then the last thing, as a leader, as you facilitate these interactions, you have to make sure the non-dominant personalities' opinions are cultivated and brought out in equal measure to others. I could go on, but I'll pause there. That's some tips.
Sure. So I think how you think is more important than what you read or what you think. Yeah. Sure.
Yeah.
Go ahead.
All right. With your permission, I will move on. All right. Our next segment is alpha hidden in accounting statements. Now, how is that possible? It's possible because, in my experience, people, meaning research analysts, PMs, CIOs, they miss a very important thing. That is that accounting statements are not just quantitative, they are qualitative as well. These are measures of the choices, actions, behaviors, decisions, and ethics of the management teams that run the businesses that we're trying to analyze. And embedded in there are all of these behaviors on their part. They also tend to be very difficult to change. One of the reasons we'll hear later that it's difficult to meditate is because it's difficult to change behaviors, right? It's difficult to develop a habit of meditation. Well, all of us, no matter how expertise, no matter how high our level up in life, job-wise, even if we're a CEO, it's hard for us to change behaviors. Therefore, the accounting statements have embedded in them insights about the behaviors of management. And as we'll see later in the lie detection section of this presentation, there's strong evidence that businesses tend to repeat the same errors over and over again. So I encourage you, as you're reading the financial statements, read them as expressions of the behavior of management teams as well, and not just cold expressions of execution and the data accumulated thereafter. And I'll give you one brief example of that. it's a very different thing when you look at a business and you see that the CFO in the financial reporting has chosen to say something like customer sales versus a very chilly net revenues. If the business has chosen words or verbiage like customer sales, that tells you a lot about the culture, that they are very centered on the customer experience as opposed to a net revenues. Just a very simple example of how the behavior is there embedded in the statements. Next, I'm going to talk about 5 mistakes I see with regard to financial statements. This is a little bit crossing over to the analytical side of things, but I will highlight the behavioral thread in each of these. The first error in judgment that I frequently see is we tend to use generalized financial statements. It's very tempting to use big data services like Bloomberg or FactSet or I've forgotten, CapIQ is S&P's product, if I'm not mistaken. They've changed their name multiple times. I think it's called CapIQ. And when we do that, we lose some of the behavioral content that I was just describing on the previous slide, because they are using a template that is generalized for all companies, which facilitates comparisons, no doubt. But what you lose sometimes is the refined, granular detail that indicates the behaviors that are present within a management team. So for example, there can be like the exceptional items category, and sometimes it's reported as a block, but individual teams, they may have 3 or 4 of those categories and they recur. And the nature of the recurrence of those categories is an indication of the same errors in judgment that management teams make over time. So I used to require of my analysts, they hand enter the data, which they despised. They hated that. I only did this in the initial parts of their career. And I made them do that so they became familiar and tangible with the essence of the business. And though they always complained, inevitably they came and they thanked me and they said, oh my goodness, I have much better familiarity with the individual nature of the business of which I'm looking. And I have a higher level of respect for that process. And how do you control for errors? That's the natural question. By building in sums and minuses into your financial statements as you hand enter that data to ensure that your numbers match those as reported in the big data services. Incidentally, minor digression, General Pacific, I've never shared this publicly. I've told the story, but not the company. I once caught General Pacific's gross margin number or gross profits number incorrect relative to the mathematics embedded in their financial statements. So we have revenues, less cost of goods sold, ought to equal gross profits. It didn't. It was about $70 million off. I called their investor relations professional who denied that that was possible. I said, run the number, grab your calculator right now. And it was off. And he reported to me, I was the only analyst on globally that looked at global Georgia Pacific that caught that error. The data services reported it as an error. And so it's entirely possible that you're using the wrong data as well. Next big tip, not understanding the reflexivity of the statements. That is how they interrelate to one another, how the balance sheet affects the income statement, how what happens on the income statement affects the balance sheet, how all of that affects the cash flow statement. I highly encourage as an exercise, creating your own cash flow statements. If you don't know how to do that, refer to your accounting textbook. That sometimes is a very interesting exercise because the cash flow statement doesn't always represent or come out as you would expect it based on how the company reports it. That can be quite interesting, and it will reveal how the company is characterizing certain expenses, cash expenses. And I've noticed lots of times what I consider should be a cash flow from operating expense is categorized as an investing expense or a financing expense. And to me, they're juicing or goosing, if you will, to use a little bit of North American slang, their cash flow from operations number, which of course is so important for free cash flow calculations. The next big one is unified temporality. What do I mean by that? The cash flow statement, the balance sheet, and the income statement are all on different temporal dimensions, time dimensions. And if you want to get insight, you need to put them all on the same temporal dimension. So if you're using FASB or GASB, the cash flow statement in the third quarter is an accumulation of cash for all 3 quarters up until that point. And companies will hide some of their transactions and what the nature of those are and take advantage of that. I'll give you an example. Crown Castle International, again, I've never revealed this publicly. I've talked about the story, but not named the company, once engaged in this activity. They bought their cellular communications company, and they bought a huge portfolio of towers from the BBC in the UK, and they did it as a sale leaseback. And so they were leasing back these towers and they owed payments to the BBC. And what they did was they delayed payment on one of their lease payments from March the 31st to April the 1st. Why did they do that? Everybody at that point was looking at the cell phone business. This is circa 1999, 2000, to see which one would be cash flow positive for the first time. And Crown Castle was the first to report cash flow positivity in the first quarter, I believe, of 2000. And yet what was very strange is in the second quarter cash flow statement, their cash flow from operations barely changed. Why is that unusual? Because the cellular communications business is such that if you add more antennas on a tower, it's almost pure cash flow because the tower is already erected and the hardware costs are borne by the carrier themselves, not the tower owner. And it didn't make sense that their cash flow had barely incremented. But I knew that because I put the temporality, the temporal dimension of the cash flow statement quarter by quarter rather than an accumulating flow. Consequently, I was able to see it barely went up. I called the company, asked them about it. I got a call from the CFO, the treasurer, interestingly enough, and then the corporate counsel about 2 weeks later, and they admitted that they had delayed their payment to the BBC by 1 day, and they rolled that payment over into the second quarter, so they still reported positive cash flow in the second quarter. Again, nobody in Wall Street had ever noticed that. And what was this an indication of? That is a deceptive management team. I sold on that basis. Even though I was thrilled that they were the first to report positive cash flow, the behavior that I sold was their deceptive management team. I couldn't trust it. Next, not adjusting for distortions. This is a classic. I don't need to tell you this, but I still find to this day, I do embedding work with management teams of businesses and research analysts and CIOs, PMs. I still see that when they're doing this, they rely upon third parties to adjust for one-time items. You should do it yourself. Why? And a hint, if you see an estimated loss from a write-off of an asset that's a round number like 500 million rupee, and I know you in India, I'm still confused by crore in the numerical system, so I can't quote that. So I apologize, I'm not going to use Indian mathematics here. But 500 or 450 or 800 or 850, we see rounded numbers like that. You know, it's an estimate from management. It means they don't know what's going on. And you need to, that's an indication you need to really find out what their thinking is. So that's a behavior embedded in that. And of course, not reading the footnotes is a key question. Now, in terms of a bonus, I'm going to share with you, I think, one of the biggest secrets of all time. I've written about it occasionally, not much publicly, and that is additional funds needed analysis. You have to do AFN because too often we as analysts treat growth as free. Growth is very expensive to a business. It's also something that really devastates the management of a business. A fast-growing business needs to find new employees, new office space, new distribution channels, new salespeople, so on and so forth. And if they're growing rapidly, the 87th salesperson they hire is probably not as good as the 10th. The new office space is necessarily not as good or located as well as the initial office space or distribution location that they had previously. Yet people treat it as free. Additional funds needed analysis integrates the reflexivity of the statements, which I encourage you to do, but it also penalizes companies for growth and makes it more difficult because it intentionally puts on there the cost of raising capital. Navneet, I'll pause there if you have any questions or comments.
No, again, I like the ABCDE, and I think if people follow all of these, they can reduce the number of F, which is the failures.
Yeah, agreed. Yeah, and people don't tend to look at the behavior that is also represented in those numbers. Those numbers are evidence of behaviors, which are quite important to note. All right, moving on. Evaluating executive management. This is one of my favorite topics. It's a new line of business that we've been developing at Focus Consulting Group. It was an emphasis of some of my research when I was content director at CFA Institute. And it's something that most firms do on an ad hoc basis. There's not a lot of structure or science brought to how they interview executive management. But Nandi, I know you know how important it is to have those conversations with management teams, and many firms don't have structure to it. So let me share with you some secrets. First of all, as you're doing your fundamental analysis, your financial statement analysis, reading through the formal documents, begin to author questions. Anything that you're uncertain about is a valid question for management, including questions about the behavior if you begin looking at the financial statements for behavior. Why did you make this choice? Why is your strategy cemented the way it is when your competitors are executing a slightly different strategy than you? What's the logic behind that? Is that a constraint based on your capacity? Is it a constraint based on your capability of execution to monitor financially? Why is your strategy different, right? So author those questions as you do your fundamental analysis. I used to keep a piece of paper, which of course is not rendering with my virtual background, but you can kind of see its ghostly image. I would have a piece of paper next to me as I did that work and would write down questions. I usually would have around 30 to 45 questions, and I would then begin to whittle it down. Next, when you talk to management teams, this is especially valid for those of us on the webinar who actually have the ability to interact with them one-on-one, which I recognize for CFA candidates maybe not the case. But if you're already working in the industry, begin to ask them, and I used to open every initial conversation, what's your ideal shareholder? And to a person, they always said nobody had ever asked them that question. I was a long-term, low-turnover investor. The firm I worked for, we had shares of American Express who were originally purchased in 1969. And so we had held them for almost 40 years. And we had a very intimate relationship with American Express, for example, and we're their second largest shareholder. And we used to ask that question all the time. Who is the ideal shareholder? And what does that relationship look like? What do you rely upon? And to begin to build a bridge, it's not us versus them. It is in some ways. You always work to remain objective. You don't want to be too intimate with them, but you also want to recognize that they can help you, you can help them. And I'm not talking about insider information. I'm just talking about asking them how they would like to relate to a shareholder. And oftentimes that builds a level of intimacy. Now, here's the objective story there. With that level of intimacy, they tend to share more with you. It's not always insider information, but they'll explicate. They'll give you more of their time. And so instead of a 15 or 30-minute conversation with them, they'll grant you 60 to 90 minutes because they recognize the intimacy of that relationship. So just begin to develop a relationship with them as you would with individuals. Remain objective, though. Don't fall in love with the company, which is all too tempting. Next thing, when you're interviewing management, structure your conversation. I always used to ask very easy questions first to sort of break the ice, if you will, and then get greater in depth with analytical questions. And I tended to structure the questions as easy questions up front, things like strategy, questions likely to be repeated by other analysts at my competition, which I knew were easy for people to answer. Then I would then switch to more complicated questions. One, they're warmed up, they're more likely to answer them better. And then I would hit them with really difficult questions last. And that then leads into my next bullet point, how to access top management. It's very frequently the case that if you are working for a firm and your position in a company is not large enough to even register on their top 10 or top 20 shareholders, they will not give you really the time of day. And you may have access to investor relations, but not to the CFO or the CEO. So to access the CFO, I was always developed from my analysis a very complex financial question likely to escape the abilities and capabilities of the investor relations professional. Inevitably, they would kick that question up to the CFO. And frequently, about 50% of the time, the IR person would call me back or email me back with the answer from the CFO. But nonetheless, there was a channel built to the CFO and a level of intimacy that hadn't been there before. The other half of the time, though, the CFO would arrange a call with me to explain matters. And thereafter, they would invite me frequently to call them directly with those kinds of questions. They appreciated the level of the depth of the questions that I would do. CEO, those are great. The complex questions there, the great ones are about strategy. CEOs tend to obsess about strategy and culture issues. Culture, again, is embedded in those financial statements. It's in the annual report. Culture questions frequently get kicked up to the CEO, especially prospective ones, because the CEO is charged with thinking strategically. Now, a bonus on this section. When I was evaluating executive management, I very frequently would ask the following question, which I considered a billion-dollar question in terms of value. And the question was, and I've never shared this publicly before, was what aspects of your business do my competition frequently misunderstand? And that question is said another way, What did I leave out of my analysis? Or what do other people leave out of their analysis that is important? In other words, show me the alpha in your business. And that question is a very, very powerful question. All right, next, and I'll be brief in this section. I'm going to be a little bit opaque here necessarily because this is a new product line we've developed at Focus. It's called Deception and Truth Analysis. The acronym there is DATA. And most people think of lie detection or truth detection, which is crucial in evaluating executive management. They think of it as a body language phenomenon. And that has been tested in social psychology since 1958, and it's been definitively debunked. Body language does not work to identify lies. It does identify behavior, but the assumption is that people who lie are anxious. Frequently, that's not the case. It's also frequently the case that people who are truth tellers have anxiety. And so, yes, you can tell anxiety, but that isn't necessarily indicative of lie. The global success rate of relying on body language to be able to identify lies is around 54%, so about 4% better than chance itself. Not very good, not very reliable. There are techniques that work, and that's what I'm going to share with you right here. Text-based analyses, and this is what I've developed as a product line for Focus. This is literally the first time I've ever discussed this publicly because it's only about 2 to 3 weeks old in terms of the development. So I've developed 4 algorithms that can analyze the text of any business and very rapidly. It can literally assess millions of words of data. It's based on scientific research that has identified behavioral cues within text communications. And the algorithms, if you look at the Dow Jones since 2009, and you just, very simple decision rule, I don't buy the top 5 deceptive companies. On average, over the 11-year period, I outperform the Dow itself by 84 basis points. The total amount is nearing 10% over that 11-year period on a compounded basis, and it outperforms the 9 of 11 years. So, and then the next text-based bit of interesting information based on this data algorithm, and I've given you enough, you can go research this subject yourself, and perhaps you can replicate this if you'd like to. The other piece of research I just did this week, which is very interesting, is I looked at the 11 largest corporate scandals of all time, including Satyam, sadly enough, for Indians. The rest, of course, are owned by Americans. Not surprising. Enron, I'm talking about WorldCom, so on and so forth. And you can evaluate the liability or the lies of management in their annual reports and other executive communications. And on average, the data algorithms gave a 2 to 4 year warning ahead of time and identified all 11 frauds and with a 2-year warning. And it, the one exception being AIG, which was a huge corporate scandal in 2004. 2004 is when the scandal broke. The SEC in the US investigated AIG and they asked them to restate 3 years of financial statements. It did identify all 3 years of those statements, which had been, I believe, 1999, 2000, 2001, and maybe 2002. There were 4 years. It identified all 4 years deception in those statements. So that's one way you can begin to evaluate executive management. The next is indirect context questions. That's IC, as in I see things more clearly now, questions. And I'll give you an example of one. Investor relations professionals are very used to the same suite of questions. So are the CFO, CEO, and other execs at businesses. You can't ask direct questions of crucial information or they'll see it coming. So the story I'll tell, and it comes from my book, The Intuitive Investor. Devon Energy was a company I owned, and they were pioneers in a thing called coal bed methane extraction, which is extracting bubbles from natural gas bubbles contained in water, which is about 200 feet below the earth. That is a very inexpensive natural gas well to drill versus a 5 miles into the crust of the earth well. And they were pioneers, and so they had a very low cost of extracting natural gas. Everybody wanted to know where else they were looking for properties, and it was well known where those properties were. And one day I was at a conference, I heard all kinds of sell-side analysts request this information, and they would say, we're looking all over, right? They knew that question. So my question to their chief executive, their chief who was in charge of exploration and production globally was, what foreign languages was he studying? And he said Polish and Czech. Now, that's a very unusual thing to be studying. And I also knew that the Venn diagram was a perfect overlap with where else there was coal bed methane. So that is indirect context. I knew the context of the exploration production person was he's probably negotiating contracts on behalf of Devon. He's going to want to understand those contracts. So that's a context that he's familiar with, but it's different than the context of the coal bed methane, just by 1 degree. But he was unprepared to answer that question. Because it was exceptional, he answered it, and I knew where else Devin was looking. The last lie detection technique is called SUE, strategic use of evidence. If we have evidence of a lie, we're usually taught, if you've studied the subject at all, to hit the person we're questioning with the fact or the evidence of a lie, not proof of a lie, up front. Supposedly that makes people more anxious. If it makes them more anxious, their body language is going to be more volatile. If it's more volatile, we can notice the lie. Again, body language doesn't work. Strategic use of evidence turns that on its head. It says you ask broad context questions first if you have evidence of a lie but not proof, and you gradually narrow down your context. Why is this important? It's important because liars and truth tellers both want you to believe them, but their strategies for doing so are very different. A truth teller, when they start to detect your line of questioning or they suspect that you don't trust them, they will begin to guide you toward the truth or the evidence that will prove their point. That's the behavior of a truth teller. Think of it, if you're arrested by the police and you're being questioned, you're going to want to exonerate yourself as soon as possible. Whereas the liar has a very different strategy. They want to steer you as far away and as soon as possible from the evidence as soon as possible. Strategic use of evidence moves your lie detection accuracy. The highest measured so far is around 80%. It's been measured at 78% and 82%. So give or take, the average is around 80%. So if your line of questioning, the behavior you see in somebody is that they steer away from the subject and they don't want to answer the question, and the line of questioning is uncomfortable for them, that's very strong evidence of a lie. I will pause there. Navneet, do you have any questions or statements?
Sure. There was a question that what sort of behavior is covered under these algos?
I look at 54 different factors, and they're proprietary. I will give you one. The type of behavior that is assessed. I can also identify other underlying behaviors, and I'm using this in a human resources context too as a consultant to sift large bodies of resumes to look at underlying behaviors. So leaders tend to use third-person pronouns much more frequently. They say we because they feel that they have the authority to speak for the entirety of an organization, whereas subordinate employees tend not to say we, they tend to say I. So that's a type of a behavior I can tell from text very, very quickly. So if I see a high proportion of third-person pronouns being used relative to the total amount of speech being used, and especially in relation to first-person pronouns, I can assess very quickly that that person thinks of themselves as a leader. So that's not quite on the lie detection. I don't want to say more just because it's a new product and we're still developing it, but you can absolutely tell behaviors from text-based. But there are 54 factors that are used in those algorithms.
And when you say the text-based algos, you mean like the natural language processing that you use, right, at your end?
It's not NLP. Again, I'm going to be a little bit oblique. It's actually much simpler than that. What it does is it looks at various parts of speech. So use of adjectives, use of verbs. In total, there are around 80 factors that are used in a text-based analysis software that I have. And then of those 80, about 50 in various proportion tend to be indicative of lies. I've given you enough that you can go research text-based lie detection that you should be able to infer the initial thread, and you can go down that rabbit hole as I have done over the years.
So relative to the world just 2 months back when we were having physical meetings, I mean the in-person interactions, and you have the management team, you also look at the verbal cues, you look at the gestures, you look at how they are interacting among each other and all of that. But today, what are the things that you need to keep in mind when you have these virtual interactions? How the virtual interaction is different than when you're meeting a management in person? Is there any difference, or you should look at it exactly in the same manner?
Well, here's the thing. I, unlike the scientists, believe body language can be used a little bit to indicate behavior, but I need to caution to be very careful. Going back to the emotional intelligence factor, the wisdom factor, it is all too tempting to read too much into these things. If you are confident that you see the world for what it is, not what you would prefer it to be, then you can rely upon body language. However, the scientific literature is unequivocal. It's actually one of the most researched topics in all of social science, that is lie detection. Body language is very difficult to rely upon to be indicative of deception. It can be relied upon for underlying behaviors, but you want to be certain that the behavior that you're witnessing is causal, right? That the behavior I've witnessed is cause to be concerned about an outcome that the business may be generating. So I would caution you against that. Otherwise, if you're not relying upon body language, indirect context questions could even be done via email. Strategic use of evidence as a technique can absolutely be done virtually, as we're doing it right here. Because in a line of question, if I start with broad context, I'll give you an example. I used this technique on Hewlett-Packard back in the day. We were the 9th largest shareholder of Hewlett-Packard at my firm, and we suspected them of fudging their Southeast Asian printer sales. And you start with a broad context. How was the quarter? Okay, very broad. They start to relate that to you. You say, give us a global breakdown. How were the printer sales? They tell you. How were printer ink sales? Printer ink sales, so you're gradually narrowing the context. Region by region. How was North America? How was Western Europe? How was Eastern Europe, which at that time was a developing market? How was Southeast Asia? And if I notice, as I narrow the context, a steering away from wanting to relate that information, and it seems aggressive and emotionally charged, it's typically indicative of some sort of lie. In this case with Hewlett-Packard, they actually guided us directly to the information we wanted. So they said, oh, let me pull out a piece of paper and I'll tell you exactly what printer ink sales were in the Philippines, printer ink sales in Indonesia were. And so it was the opposite behavior. They wanted us to believe them and were willing to relate data. We had evidence of a lie, but not proof. So these techniques still work one-on-one.
Sure.
All right, I will move on. I know there are lots of questions. I see them accumulating in the queue. Now we get to controlling emotion and overcoming bias. This section will move by much more quickly, I promise. The first thing I want to tell you is that if you are a fundamental investor, your assumption is that your control of your emotions is different than the emotions of the market. It has to be. Said another way, we trust that other people's behaviors are on autopilot, ours are not, okay? So that indicates very naturally what you ought to be emphasizing. Your fundamental analysis, yes, look at the data, but look at the data as evidence of the behaviors of the management team. It also means look at the behaviors sometimes of other shareholders. So I used to look at the shareholder list of top shareholders, and if I saw investment managers who I knew were skittish and would sell like crazy and sell their entire position if there was smoke, in other words, they treated it like fire, that was something that was built into my risk management in a particular position, because I knew that their behavior could hurt me, or that there could be a great buying opportunity if I was unsatisfied with the valuation of my share. Say I had a 1% position, I wanted a 4% position. And if I saw a skittish group of shareholders who were shareholders 1, 2, 3, 4, 5, I knew that there would be a buying opportunity on any bad news, and I could put that one at the top of my queue for watch list. So again, look at the behavior that's there. I also spent a lot of time on my own personal behavior, which is what the rest of my points are about. So the ideal thing for you to do is to develop technologies, whatever they are. Meditation is what we're going to turn our attention to in just a moment, so that you can create a pause between stimulus and response. If you have a pause between stimulus and response, then you can choose to respond how you would like to respond, as opposed to react. If it's stimulus response, it's really stimulus reaction. And one bit of evidence that you may be engaged in that behavior, and none of us think that we're that person, is if in a meeting of our peers, they say something and we immediately don't think about how what they're saying could be right. And as we're listening to them, we're imagining our reactions. It means our listening skills need sharpening. It means we need to get into the moment where we can pause between stimulus and response. I'm sure certain of you, some of you today on the conversation here have been reacting to what I'm saying. It's fine. Let's just acknowledge that that's difficult to overcome. So how do you create a pause between them? There are lots of technologies. First of all, get a second opinion is one. Don't be overly invested in the classic behaviors. And all of you are familiar with behavioral analysis, so I won't talk about that today. And Return to the Active Manager, my recently published book from the fall, I go through each of the classic behavioral biases and talk about how they manifest within the investment process. I refer you to that for that. But get a second opinion is one way to create a pause. You have to stop, you have to schedule a meeting, you have to walk to somebody's office, you have to arrange a Zoom meeting, whatever it is, there's a pause there. That is not just about getting the other input from somebody else, it's about you pausing on your work, and as you return to it, there's a pause there for you as well. Next, software. There are various software packages out there on the marketplace. One is Essentia Analytics, which takes trading data and analyzes trading data and looks for biases that recur within your trades. So they can identify, you tend to sell technology companies 5% too early, meaning you sell too early and you're leaving money on the table. And they then serve up alerts on your names, and they couple that with coaching so they can coach you through some of this so you can become more refined. Bonus technology. This is something I was reluctant to talk about for years and years. Perhaps the most valuable thing I can share with you all day today. Navneet, we rehearsed this yesterday. I told him that I was going to share this. I see him smiling. This is billion-dollar plus technology, and it's the best way I know of for creating a pause between stimulus and response other than meditation. And that is to keep an opinion diary. Why is an opinion diary important? Our job as investment managers, we are evaluated almost exclusively on our affirmative buy decisions. That's what's in the portfolio, and that's how our returns are calculated. But that is a very small section, subset of the decisions we make. We literally make hundreds of decisions. Most of them are no, right? We read a news story and say, oh, that company is going to struggle for another 18 months to catch up to the big dog within the space. What we've just decided is we're going to stop analysis at that very level. That is overwhelmingly most of our analysis is to say no to things, not yes, but the no's escape judgment. They are completely absent from the investment review process. And yet, if you want to improve your decision-making capability, you need to use as much data as possible. Not just the affirmative buy decisions, where certainly there are errors in judgment, but also the securities passed up that I didn't buy that were successes, so on and so forth. So to use the opinion diary, my rule of thumb was if something occupied my thinking for up to 5 minutes, I found myself distracted enough from whatever it was I was doing to follow a thread, I would then write it down on a piece of paper. I would date it. If there's a security associated with that insight, it could be where our oil price is going to go. The futures were negative temporarily. I had an insight about that. Write it down. Write down the price of oil and then an expectation. What is the thread? Sometimes there's nothing other than an observation. Write it down, review that quarterly or annually, and if there's any significant change, and review the entire opinion diary, and you can begin to get insight into the majority of your decisions, which typically miss judgment. All right, last bit. We're going to do meditation here. There tend to be 4 things about meditation in 4 different categories. So I call it fours, the fours of meditation. That is, there are 4 fictions. They are that it's only for sadhus. Science shows that we all achieve meditative states of consciousness each and every single day. The question is, what are we engaged in when those meditative states are happening? Not only that, but then you can look at meditation as a practice designed to achieve those meditative states of consciousness. Why is that important? Meditation is a powerful way of gaining insight about our own internal behaviors and creating that pause between stimulus and response. It's also a great way of beginning to recognize some of our bad habits and where they're sourced at. It's a powerful way of controlling our minds and being able to change our habits on a dime, as we say in the United States. In other words, very rapidly. The next fiction is that there's only one way to meditate. Another perception is that there are thousands of ways to meditate. From a scientific perspective, and based on how your brain is affected, there are 4 major ways to meditate, which I'll discuss in just a moment. The next big fiction is that meditative states of consciousness, you have to meditate in order to achieve them. You don't. And I'll share with you a secret on that. Do what rejuvenates you. It tends to be the activities that rejuvenate you are places in your life where you are achieving meditative states. So exercise is one. I mentioned taking a shower. Sometimes insights happen then. My wife, who loves me, she loves me even more because I like to do the dishes. I like to sweep the floor. It calms my mind, and I tend to have creative insights when I'm cleaning. And sometimes when I'm on a conference call, I have a cordless phone. I will walk around my home, and I will be dusting, and I'll be cleaning, and it sharpens my listening. So that's another thing. Next, another fiction is I tried it and I was terrible. Well, that is the very point of the meditation. The terrible part is recognizing or identifying your boundaries in terms of your ability to think what you want to think when you think it, as well as your own self-awareness. And so when that happens, just as when you're lifting weights and eventually your bicep, if you're doing bicep curls, is exhausted, that doesn't mean you're terrible. It means you're doing it right. So when you hit that moment, your mind wanders, that is exactly what you're trying to do as a meditator, is to try and extend the period or build up the meditative muscle. Specifically in meditation, as identified by science, as well as Hindu meditators, as well as Buddhist meditators, there are two big things you want to develop. One is done by a Vipassana meditation, the other shamatha, and the two skills are focused attention, choosing what to think, when to think it. So I have control over my mind and my mental processes. I don't have it run away from me. And the second is metacognition. That's awareness of awareness itself. And those are the two skills you're trying to get. And so if in fact your mind wanders, you notice, you redirect your attention to the meditative activity, and that is exactly the activity that builds up your capabilities. The next four is the reasons to meditate. Stress relief in the era of COVID, that's very important. In volatile markets, very important. The next is better and improved mental processes, including increases in creativity. The third is the ability to overcome behavioral biases. Meditation is one of the few things that's been scientifically proven to help you overcome bias. Daniel Kahneman and other behavioral finance researchers believe it's impossible to overcome your biases. That's not true. It's been scientifically demonstrated that that's not true. Look at the meditation guide for investment professionals, which Navneet mentioned, for some of the insights in the science. We don't have enough time to go into it, but it's there. And then the fourth reason is it improves your ethical profile. And then the last thing on meditation, and then I'll pause, and then I can either lead you through a meditation or we can do Q&A. There are four big styles. And you can recognize them as a Hindu practitioner. If you're familiar, you can map these to various practices. These are the name science is given these practices. The first is focused attention. I know that that's like a shamatha practice. Here I meditate on one thing to the exclusion of all others. Your breath is a very common one. Could be a white wall, candle flame, doesn't matter. When I'm walking in New York City, the don't walk sign as a pedestrian flashes, I will walk up a block from my hotel to my meeting, and I'll stare at the don't walk sign. And if my mind wanders, I notice, I redirect my attention to the don't walk sign. You can do it to your breath, it doesn't matter. That's very good for creating the ability for top-down control, choosing what to think, when to think it, and for mental focus. We talked about attention and how poor it is in the modern era. Focused attention meditation is brilliant for developing attention. The next is open monitoring, very similar to a Vipassana, sometimes called a mindfulness practice. In Vipassana, we rest in awareness of our sensory experience, our inner mental experience, and as we notice those things, we don't judge them, we don't fixate on them either, we acknowledge it, and then we let them slip from consciousness and we return to general awareness. So if my eyes are closed, I could pay attention to the temperature of the room around me, it could be the feeling of this shirt on my skin, could be the taste of my mouth from having had my morning coffee. It's morning here in the US, so on and so forth. As I notice those things, I let them slip and then I return my consciousness to awareness. Very good for developing metacognition. And by the way, that's something I highly encourage. Practice multiple forms of meditation or combine them into one overarching meditation to develop these skills. The third meditation is a visualization. Hindu meditation, like meditating on Ganesh, or if you're Buddhist, meditating on Guru Rinpoche, for example, if you're Tibetan Buddhist, or on the Buddha himself. Those are forms of visualization meditation. In sports, very frequently people visualize the improvement. If you're playing cricket, for example, how you wield the bat. I believe it's called a bat, right? I'm not a cricket fan. How you wield the bat and your stroke facing a particular type of, is it a pitcher? Do they call it a pitcher in cricket? I don't know. You can visualize your at bat, as we would say, right? You can visualize that. The last one is a compassion meditation. And that is where I focus on forgiving myself for my faults. So it's unconditional self-love and forgiveness. I then extend that to my friends, colleagues. I can extend it to my neighbors, my city, my country, the world, the universe, so on and so forth. And that's great for, of course, developing compassion. Oh, and visualization is great for developing creativity. I will pause there. I know I've spoken overly long. I apologize.
No, It's okay. I think you did some exercise when you came to Delhi, but you could have done that for doing a meditation today, but we don't have the time. I'm sure some other time we'll have another session with you, particularly on meditation, because I also feel very passionate about it. In the interest of time, though, we have exceeded a bit, but there are multiple questions, and I would urge you to be very brief. So the name of the software which was mentioned for analytics?
Essentia. It's like the word essential without the L on the end.
Okay, Essentia. And could you speak more, a little bit more about the opinion diary? And now that people are in lockdown, I'm sure they have more time, not only meditation, but opinion diary also.
Yeah, the opinion diary turned out to be, some people say journaling. It's different than journaling because it's specifically an opinion that has an investment context. And it's also trying to log and record the entire contents of my decision-making apparatus. So don't confuse it for a journal. Though it could be interesting for a journal. You could conceivably write down something along the lines of, I tend to prefer companies that are overly aggressive. Like I have a fetish for aggressive growth names, or I tend to be overly conservative. That's valid for the opinion diary. I don't have that much more to say. My opinion diary at the date of my retirement in 2005 was around 600 pages long from the entirety of my career. And I just, and sometimes the thoughts would be, I'll give you an example of a thought that maybe people wouldn't think to put in it. There was a moment when Hugo Chavez, the president of Venezuela, kicked out the foreign oil engineers from the nation because he was a populist president. He saw that as winning his voters over to the idea that he was for them. So he got rid of all the foreigners. The problem with that is that the Venezuelans themselves did not have expertise. The Venezuelan oil is not sweet crude, it's highly sulfuric, meaning it requires higher levels of refining. For Venezuela to make money, they have to have a higher barrel of oil price in order to make money. And not only that, but the engineers are very good at extracting that heavy crude from the reserves. And so I wrote down in my opinion diary, 5 to 10 years on, Venezuela's production curve is going to be negative, not positive, even with new discoveries, because the yields from the wells are going to be lower. So that's an example of something I wrote down. I wrote down the price of not sweet crude at that point, heavy crude at that day. So that's an example of something that was an entry in my diary.
Sure. And somebody is asking, just like the managements, even the CIOs and fund managers give selective information. They are more optimistic while talking. How do investment advisors deal with that?
Well, I think my instinct.
I don't know whether that was directed at me.
You're exactly.
You help her.
I will approach and attempt an answer. That's not been my profession since 1996. I spent a 1.5 years period as a pension consultant and as an analyst. That was how I got my leg up into the industry as a research analyst at a mutual fund. And indirect context questions are very good there. So like an indirect context question that I asked of PMs and CIOs who would come and present their firms to us, if memory serves, was something along the lines of, do you ever engage in scenario planning with regard to your portfolio of investments? And what are the factors that you are looking at? And that's indirect context. If I see a thoughtful answer there and they've considered 30 different contingencies, then I know that they may not be optimistic or overly optimistic. And because it shows a thoughtfulness. And if they still hold their opinion that they're optimistic relative to my own evaluation of what is proper optimism, then if I see that thoroughness, then I know that there's probably evidence that they've been thoughtful. Another way, very briefly, of getting at that kind of a question would be to ask them what the worst case scenario is for their portfolio. Where are the holes in the portfolio? And the answer to that is very open-ended, and you're looking there not for the specifics of the answer, but the thoughtfulness of the answer. How thoughtful is that? Do they even acknowledge that there might be holes in their portfolio? And if not, then you can be assured that they're probably too optimistic.
Sure. Very quickly, is there any study which has measured the correlation between creativity and investment success? I've got a couple of questions on that.
To my knowledge, no. I would love to do that. In fact, that's on my great question. That's on my back burner of things to do. What I do have limited data for at Focus Consulting, each year we hold the for CIOs and PMs only conference where competitors come together, and creativity was the subject of our conference in October. And we asked them how important an issue to the CIOs and PMs in attendance creativity was, and they identified it, and we gave them the standard options. They actually said it was their number 2 most critical factor, but then we asked them what are their priorities as the same thing, order your priorities, and it was last. And so we know that there's a big gap, and the fact that I don't have evidence to quote to you is evidence that there's a big gap there.
Sure. In any of these text-based analysis or some of the things that you talked about, somebody is asking that once the rules are known, can it be beaten, just like people are beating the lie detector machine now?
I would be shocked that they could. And the reason I say that is the factors are so subtle. Like, for example, would you think that my use of third-person pronouns in greater proportion to first person is more indicative of leadership? Probably not. And to fool 54 factors would be very difficult. But it's an open question. It's an open question. For Focus, we are developing this product. We literally have just done the research that there's other scientific research that we have based our algorithms on. And now we've directed those algorithms to the markets as well as to fraudulent cases. And we're thinking we want to sell it to a very narrow swath of the investment firms that are our clientele for that very reason, so it maintains alpha in its power. And we're debating, how many firms to whom we would sell that technology. But I would be surprised. One last comment: the data that we did on the Dow those are the most liquid names almost in the entire world, and that you can find 84 basis points there. It would be difficult to purchase away that insight. I think it would be very tough.
You wrote a brilliant series on what makes an analyst great or outstanding, some 7 or 8 qualities. But if you want to give one advice to our young members who are watching you today or would be seeing you on YouTube later, what that would be? Apart from meditation, I guess, would surely be on top of your mind. One single advice that you would like to give to our young members.
Well, I'm going to violate your question because one's very quick. Meditation, yes, but know yourself the same, right? Meditation is the most efficient way I know to know yourself. But if you know yourself, that is I agree with Ray Dalio. The biggest, most important secret alpha generating weapon I had was meditation in my career. And I've meditated, some of you know this already, since I was 7 years old. But I've turned others onto it who are non shaven-headed cave dweller types or sadhus, who also credit it with being a big game changer for them. My biggest piece of advice would be to let your full self express. And ideally, your CIO or PM that you work for will let you be fully yourself. Investing is a full-bodied, full-mind practice. You're really trying to assess the future and natural outcomes. And the world is a huge and vast space. You need all of your weapons in use. You need your creativity. You need your intuition. You need your analysis. You need all of that on board. But if your CIO or PM doesn't grant that to you, you must grant it to yourself. And if you know yourself and you grant yourself full power, I think you're going to be much more successful.
Thank you. So I will recommend your books, but the other books that you will recommend to our viewers?
I'm fond of a couple of what I think are great books. Securities Analysis. Everybody always says The Intelligent Investor. The Intelligent Investor, I don't think is as good as Securities Analysis, Graham and Dodd. I think that one's better. It's more practitioner oriented. I also love a book very difficult to find. It's been out of print for 20 years. It's the best book on valuation I've ever seen before. It's called Financial Valuation, Business and Business Interests. It was edited by a guy named James Zukin, Z-U-K-I-N, as an outstanding book. And other than that, I'm not a big fan of a lot of the investment books, but that's not because I don't believe in other investors. It's because publishers don't tend to respect that investment professionals' attention is long. And so all the books are truncated and too narrow, in my opinion. meaning that what you really need, because it's a whole-bodied, whole-brained experience, is a whole bunch of books. I love Intuitive Investor, my book, because it's the only one I know of that talks about intuition and creativity, but it's dated. I would recommend my book, but I have more information to share than that book that's now 10 years old has to share. So I hope that was helpful.
Thank you. So there's so many questions, Jason, but we have exceeded our time. I'm sure we can have another session on meditation, so that the thing that you put it very nicely, the pause between reacting and responding, how we can improve upon that, I'm sure. And particularly in these times of lockdown and stress, that would be very interesting and important. But right from ideas for creativity to ABCDE of hidden accounting mistakes, to behavioral biases and tools to deal with them, to lie detector tests for management, to opinion diaries, I think I've covered a whole gamut of things, and can't thank you enough. Thank you so much for being with us this evening. And again, I request all our viewers to give their feedback. The link is live, as well as watch the video on the YouTube channel, which will be put up after a few days. Thank you so much, Jason.
My pleasure. Thank you, Navneet. Thank you, CFA Society India. Of all the societies globally, always my favorite. Always.
Thank you. Thank you.